All right, we got markets down about 5% over the last 2 days, right after Jerome Powell came out yesterday morning, around this time right here, announcing the change of plans to increase interest rates by 50 basis points instead of 25 basis points in May. So if you ever question the power of the Fed to influence the markets, this is another clear example of it. I think Powell made this announcement around 11 or 12 o'clock yesterday. Market dropped about 2% yesterday. It was down as much as between 2.5% and 3% at the lows today. Made a little bounce here. Now it looks like we might have a support line right here, but it did bust through it a few times today, so it'll be interesting to see if that holds up or not. And if not, the next support line might be around 41.73. Not financial advice, just opinion. But, like I always say, I'm a day trader. I'm personally not comfortable leaving my money in anything overnight right now. Just my personal preference, not recommendation for anybody else. You got to think about how out of whack this market is with historical PE ratios. So even though I think Warren Buffett's a fraud, I do like his little indicator here, which is the stock market compared to the GDP value. And basically, anytime it's over this line, which represents the GDP, means that the stock market is overvalued in comparison to the rate of GDP. Anytime it's under it, buying it out of value. This is why the market scares the hell out of me right now because, as you can see, we're at an all-time high on this chart. This is another indicator that I like a lot. It's the amount of margin debt used to buy stocks. Margin debt is just borrowing money to purchase stocks. And as you can see, each time this hits a new high pretty much, it is followed by a pretty sizable decline. And that is because once stock prices start falling with a lot of margin debt in the system, margin calls start happening, and it becomes a sort of self-reinforcing effect where more margin calls happen, more people have to sell whatever they have to cover that margin, and it just compounds on itself. So again, I'm not a financial advisor. I'm not giving anybody any advice. I'm just saying my own personal opinion, how I look at the market right now. This is another chart that I like a lot, very straightforward. So if you're unfamiliar with the term bull versus bear market, bull market is when a period of time where stocks are going up. Bear market is a time period where stocks are going down. The average bull market ranges from about 7 to 10 years. The average bear market ranges from about 1 year to a year and a half. This one only goes to 2018, so this should be, like somewhere over here right now. Still, point being, just based on, historical facts and whatnot, we're pretty overextended. It's one thing last year where the Fed was trying to keep the market going, but now the Fed's trying to fight inflation, putting that as a higher priority than keeping the market going. That's what's really scary. So it will definitely be an interesting year going forward, but we'll have to sit back and watch. Let me know if you have any questions. Again, all opinion. None of this is financial advice. Be safe out there.